What if your phone buzzed with a notification, a deposit you didn't work for, didn't trade for, and didn't even think about, and it just kept happening? That's not a fantasy. That's what dividend investing actually looks like when it's built the right way. In this video, I'm going to walk you through exactly how to build a dividend portfolio from scratch, the mindset, the strategy, how to pick stocks without drowning in research, and the one daily habit that quietly turns into a life-changing income stream. Stick around till the end because I'll show you the full structure, and it's simpler than you think. So leave a like, subscribe, and let's get into it. Section 1. Mindset. Before we touch a single stock, we need to talk about the one thing that kills most dividend portfolios before they even get started, and that's the wrong mindset. Most beginners jump in expecting to see results fast. They check their account after a month, see a $4 dividend, and think, what's the point? But here's the thing. Dividend investing doesn't reward impatience. It rewards consistency. Think of it like planting a tree. In the first few weeks, nothing looks different. The soil looks the same, the yard looks the same, but underground, the roots are spreading, anchoring, building. The tree doesn't grow on your timeline, it grows on its own. Dividend portfolios work exactly the same way. Those early payments feel symbolic, almost embarrassing, but they are the beginning of a compounding engine that accelerates over time. The other mindset shift you need is this: stop watching the price and start tracking your income. Prices move every day based on news, emotion, and speculation. Dividends are based on actual business profit. When you shift your focus from, is my stock up today, to, is my income growing this year, the whole process becomes calmer, more logical, and a lot easier to stick with. Now, let's move on to the next section. But before that, if you like more content like this, make sure to hit that like button and subscribe to see more videos like this. And I hope you enjoy the rest of this video. Section 2. What a dividend is. Now that the mindset is in the right place, let's make sure we're crystal clear on what a dividend actually is, because a lot of tutorials make this more complicated than it needs to be. A dividend is simply a company sharing a portion of its profits with you because you own a piece of it. That's it. Imagine you and a couple of friends own a pizza shop. After paying rent, salaries, and supplies, there's $1,000 left over at the end of the quarter. You each get a cut just for being an owner. You didn't flip a single pizza. That's a dividend. Now, a few terms you'll actually need. The dividend yield is the percentage return you get from dividends alone. If you invest $1,000 in a stock with a 3% yield, you earn $30 a year just in dividends. And one thing most beginners get confused about, that yield percentage moves as the stock price moves, even if the actual payment stays the same. It's not fixed like a savings account rate, just a snapshot of what you're earning right now versus what the stock costs. Most companies pay dividends every 3 months, quarterly. Think of it as getting paid every season. Winter, spring, summer, fall, each one comes with a deposit. Some pay monthly. And as long as the business keeps making money, those payments keep coming without you lifting a finger. Section 3. The 3 strategy. Here's where it gets interesting and where most beginners make a costly mistake. They see a high yield and assume it's automatically better. It's not. There are 3 different approaches to dividend investing, and choosing the right one completely shapes your long-term results. The first is high yield, big payouts right now. Sounds great, but the catch is that many high-yield stocks barely grow their payments over time, and some cut them entirely when the business hits a rough patch. It's like taking a job that pays well today but never gives you a raise. The income stops growing, and sometimes it shrinks. The second strategy is dividend growth. These companies might start with a smaller yield, maybe 2 or 3%, but they raise their payouts consistently year after year. Here's why that matters. A stock with a 2% yield and 10% annual dividend growth is paying you over 5% on your original investment just 10 years later without you adding a dollar. That's the compounding engine at work. And there are currently 69 S&P 500 companies called Dividend aristocrats that have raised their dividends for 25 consecutive years, including through recessions and market crashes. That consistency is not an accident. It reflects a genuinely strong business. The third approach is a blend, some income now, some growth for later. This is where most beginners naturally land, and honestly, it's the smartest starting point. You get cash flow that feels real today, while your future income is quietly snowballing in the background. Section 4. Picking stocks. So how do you actually pick dividend stocks without spending hours lost in spreadsheets? You don't need to. You just need 3 simple filters, and you can run through them in minutes. Filter 1. Understand the business in one sentence. If you can't explain what the company does simply and clearly, don't buy it. Simple businesses have predictable profits, and predictable profits produce reliable dividends. Household products, basic healthcare, infrastructure, real estate, these are the kinds of businesses people use in good times and bad. Filter 2. Look for consistency. Has this company raised its dividend for at least 10 consecutive years? Did it keep paying through 2008? Through 2020? If the answer is yes, that company has proven it takes shareholder returns seriously. You don't need to memorize charts, just verify the track record exists. Filter 3. The payout ratio. This is simply the percentage of earnings the company uses to pay dividends. Under 60% is healthy. Above 80% means the company is stretching, and if earnings dip, so might your dividend. You can find this for free on any stock research site in under 30 seconds. Simple business, consistent history, affordable payout. If all 3 boxes are checked, you're already ahead of most investors. Section 5. The portfolio structure. Now let's build the actual portfolio. Think of it like a 3-layer structure. Each layer serves a different purpose, and together they create something balanced and powerful. Layer 1 is the foundation. This is where you put the majority of your portfolio, 50 to 60%, into a diversified dividend ETF, something like SCHD, which holds a basket of high-quality U.S. dividend stocks. It's been raising its annual payout every single year since 2011. Roughly 85% of its holdings have grown dividends for at least a decade, and the expense ratio is just 0.06%, nearly free to hold. This layer does the heavy lifting without you having to pick individual winners. Layer 2 is your growth engines, 2 to 4 individual dividend stocks you understand and believe in. Look for companies with strong earnings, low payout ratios, and at least a decade of consistent dividend increases. This layer gives your portfolio personality and extra compounding potential. Layer 3 is optional, a smaller position with either higher yield or stronger appreciation potential. Think of it as the extra boost. It shouldn't dominate the portfolio, but it adds some acceleration when the rest of the portfolio is compounding steadily. That's it. Foundation, growth engines, and a booster. Most people make this a lot more complicated than it needs to. Section 6. The snowball. Here's where everything connects, and this is the part most tutorials gloss over. The real multiplier in a dividend portfolio isn't just the dividends, it's what you do with them. Reinvesting your dividends, automatically buying more shares with every payout, is called DRIP, or a dividend reinvestment plan. Most brokers let you enable it with one click, and once it's on, something remarkable starts happening. Your dividends buy more shares, those shares earn more dividends, those dividends buy more shares again. It's a loop that feeds itself, and historically, dividend reinvestment has accounted for roughly 40% of total long-term stock market returns. The snowball analogy is real. At the top of the hill, the snowball is tiny. Each rotation barely adds anything, but as it rolls, it picks up size, speed, and momentum. By the time it reaches the bottom, it's transformed. A $5 a day habit, About $150 a month invested consistently with dividends reinvested compounds into something genuinely significant over 20 to 30 years. The exact number depends on your returns, and you should always use conservative projections, but the principle is undefeatable. Time plus consistency plus reinvestment wins. The habit is the strategy. The patience is the edge, and the income builds whether you're watching it or not. So turn on drip, set up a recurring contribution, even a small one, and let the roots grow. You'll be surprised what's waiting for you on the other side.